Hello and welcome to the long-term market outlook from FXNewsWires. Here we will be looking at some of the most commonly traded assets in each of the major markets. In the currency market, we'll be looking at the euro dollar and the dollar yen. In stocks, we'll be looking at the S&P 500, and in commodities, we'll be looking at gold and oil to get a sense of how we performed so far in 2012 and how we're likely to perform into the next year. Okay, so the first chart that we're going to be watching is the euro-dollar, the most liquid pair in the currency markets, the most commonly traded currencies in those markets. So when we look at the longer-term trajectory, we can see that the price has come off sharply from the all-time double top at 160, and that the overall trajectory is in the downside direction. Momentum is clearly negative. But when we look at the shorter term charts, we can see some reasons for optimism, and this coincides with some of the fundamental arguments that are being made for why the Eurozone is likely to strengthen into 2013. These arguments mostly rest on the contention that Greece has got its debt problems in order for the most part, and that there has been a balance that's been struck between austerity measures and the willingness of the rest of the Eurozone, the non-debted regions, to approve of loan disbursements to these loan troubled countries, places like Greece, Italy, and Spain. So with the given likelihood that the Eurozone is likely to rectify most of these problems, that we're likely to also see lower interest rates from the ECB, the fundamental picture does also support a potential technical picture that will suggest that prices rise into 2013. Okay, so while the long-term trajectory is clearly to the downside, as prices hit 160 and then had trouble with 150 later, created something of a double top, and then fell much lower into the 120 region, prices were able to find buyers, in advance of the longer-term lows in the mid 118s, and the rally has been fairly sharp if we look at the shorter term charts. Okay, so in addition to that, if we look at the latest bear decline from just above 149 into 120, we can see the prices rose to a 38.2% retracement, Fibonacci retracement of that decline, which is also where some key moving averages reside, as well as some historical resistance levels. So the confluence of all these levels does suggest that there is a major turning point that can potentially be seen in the near future. This rests in the mid 131s, 131.40, let's say, as this is where the confluence of technical resistance levels rests. So essentially, we have some shorter-term positives as we break this series of lower highs starting from February of 2012. We have seen a reversal of some sense there. The only problem so far is that we haven't clearly broken this 131.40 level, and if we look at the shorter-term charts, it does create a triple top in this region. Triple tops are unlikely to hold. If we do see a fourth test, quadruple tops are very rare. So if we do see another test of these levels, it's much more likely that we'll break to the upside and come back above these moving averages, which would likely send us into the next major Fibonacci resistance level, which is in the 138s. So looking at roughly a 6-month time horizon, the first 2 quarters of 2013. We do expect that this 131.40 area is likely to break. This could very well happen before the end of the year, even though volatility is likely to slow into the holiday months, into the holiday weeks for the rest of this month. Any break and daily or weekly close above 131.40 is an extremely bullish event, and will target prices longer term into the mid 138s. The next pair that we'll look at is the dollar yen, the second most commonly traded pair in the Forex markets. Here again, the longer term trajectory is to the downside. But when we weigh risk to reward ratios and oversold conditions and things like that, we do start to see that there's much more upside potential than downside risk. Prices on the shorter term are contending with the 83.5 area, so this is likely to pose some problems in the coming couple weeks into the close of 2012. But if we do close above here by the end of the month, we can expect prices to move sharply higher as we see another confluence of resistance levels in the 94.5 region, which is also just below critical psychological levels at 95. Here we see the 100-month exponential moving average, along with Fibonacci levels and historical resistance to create the next target for this pair once prices are able to overcome the 83.5 region. In addition to that, the MACD is looking to cross into positive territory here, which would also be a bullish event. So, the main argument here is that the yen is likely to continue to weaken on continued central bank stimulus measures from the Bank of Japan. In addition to the fact that the country is, overly interested in decreasing the value of its currency, given the fact that it's an export economy. So, in those cases, a high currency value is not favorable. The central bank in Japan makes continual, suggestions that it will, look to devalue its currency any way that it can in order to keep its export market strong. So the combination of these factors is likely to send the dollar-yen pair through shorter-term resistance levels, and then put the 6-month target for the first 2 quarters of next year in the 94.5 region. Okay, here we move to stock markets. We can see that prices, of course, moved sharply lower into the end of 2000 and into 2008 as the credit crisis was the main story, and brought investors out of the market, out of the stock market at least, and into assets like the US dollar. The recovery here, though, has been gradual, which is a much more valid structure when we're looking at things in price terms. Excessive drops, excessive changes in volatility tend to not be taken, as seriously over the longer term. They're less likely to hold up over the longer term. So the fact that this recovery has been much more gradual is also much more encouraging. Prices are holding well above their longer-term moving averages. The shorter-term moving averages are holding above the longer-term moving averages, which is also suggestive of continued higher prices. We are well off of the all-time highs that we're seeing just below 1,600 in 2007. So prices do have much further to extend before we see any major corrective moves lower. The MACD is in positive territory, so all of these things point to continued upside in the pair. From a fundamental perspective, we can look at central bank measures again as being supportive. The U.S. Federal Reserve has pledged to keep interest rates at historical lows well into 2013. So there's unlikely to be any restrictive measures that are implemented next year. So all these factors are supportive. When we look at the shorter-term charts, we can see some interesting developments here. Again, we're breaking some shorter-term trend activity, some shorter-term downside trend activity with these latest moves higher. These latest bullish moves are propelled largely by the strong retail sales that we're seeing on Cyber Monday and the expected Santa Claus rally that should be seen into the end of this year. Corporate earnings have been mostly supportive, with most of the companies in the S&P 500 beating earnings estimates. So the combination of these factors are likely to send prices higher into the first half of next year. Looking from a shorter-term technical perspective, 114.30 has been a major level of resistance. You can see on the chart that we're grinding through this area now. The fact that we're above longer-term moving averages, the 100 and 200 period, the 100 and 200 day exponential moving averages, as well as this strong bounce off of the 1340 region, which was also the 61.8% retracement of the rally from 1260. All these factors point to continued upside and suggest at least a test of 1470, which would be a full retracement of that move. We are, as we can see, in a longer-term, bullish trend channel. So the next major level of resistance to watch comes in at 1500, and that's mostly going to be for psychological reasons. When we see big round numbers like this, tested in the market, investors tend to become reluctant to push prices higher in a forceful fashion. So we are likely to see some stalling, at least into the 1500 area. However, longer term, we do expect that at least these highs at 1470 to be overcome before. Well, this would actually, the time frame for this projection would actually be much sooner than the second quarter, the end of second quarter projection that we've been talking about for some of these other assets. So we would definitely look for the 1500 level in the S&P 500 to be tested sometime during the first quarter of 2013. The next asset that we look at, we turn to the commodities markets and we look at gold. If we look at the longer term charts, let's just look at a weekly chart, just get some idea of how this asset behaves. Usually you don't see volatile price movements in one direction the way that you do in gold. This is a story that's often discussed in the market. Gold tends to move higher as a safe haven alternative when investors look to move out of stock markets, and when investors are also concerned about potential currency devaluations. Gold is usually used as a protective asset in more uncertain times. So even while the longer term expectation is that growth should recover for the most part in 2013, there is little to suggest that gold will see any massive moves lower, given the overall momentum that's seen in the currency, in the asset and the commodity. So with the longer term bullish momentum and the fact that there are still inflation concerns, currency devaluation concerns that are associated with quantitative easing, which has been proposed by the Federal Reserve. The fundamental expectation is that prices will move higher in gold, albeit at a probably slower pace, given the fact that it's unlikely that prices can move in one direction, indefinitely. Okay, so we are seeing some stalling. When we look at the shorter term charts, however, we can see that a range is developing at 1520 on the downside and to the upside at roughly 1790. So what we're looking for here is for this range to break in order to get a real sense of where prices are headed next. We are seeing something of a double top when we look at these charts. So it's likely, if this level is tested again, it's unlikely that these levels will hold. It's very rare that you see a quadruple top. It is possible in these in markets, but it's less likely. So we would expect that if prices do test these areas again, the 1790 area, that it is more likely that we will see a positive break, and we will see prices move higher. That and the fact that we're seeing some pretty consistent higher highs, as well as the fact that prices are trading above their moving averages. These are all bullish events. So for the most part, the bias is to the upside, and we would look for prices to trade into the probably mid 1800s into the second quarter of next year. The first indication of whether or not this forecast will be true will be the direction, the next direction of this range break. So for example, if we did see 1500 trade before 1800, that would suggest some stalling and some risk to the forecast that prices will trade higher into the first half of next year. Okay, the final asset that we look at is the oil price. This is a trickier asset, at least from a technical perspective, given that the current formation that we're seeing is a symmetrical triangle. This is a consolidation pattern that shows a level of indecisiveness in the market. It essentially shows that there aren't enough fundamental factors to push prices in one direction or another with a clear movement. For the longer term, prices have recovered from the lows in oil that we're seeing in the 35 region. But when we look at the shorter term charts, a weaker picture does become clearly possible as we're seeing lower highs since March of 2012. So that, along with the fact that we have broken the 61.8% retracement of the rally from 77.20, does suggest that we could see a retest of 77.20 sometime early next year, sometime in the first quarter of next year. So the main level to watch going forward first is 84.40, and if this does break, then the next target does become 77.20. We would need to see prices trade back above their daily exponential moving averages in order to get bullish on this pair. A lot of the problems psychologically have been happening in the 90 area. We would need to see maybe a weekly close above 90 in order to start to see sentiment turn around. But the real thing to watch here to the upside is going to be the moving average activity, as this has been one of the major bearish factors that's been in place in the fourth quarter of 2012. So if prices are able to move above the moving averages, we turn to a buy on dips mentality. But if 84.40, 84.30 gives way, is not able to sustain itself, then the next target becomes 77.20 before any upside bounces are expected. This is the longer-term market analysis for the major markets from FXNewsWires. These forecasts are based mostly on the potential price activity that should be seen in the first 2 quarters of 2013. And the longer-term projections for some of these pairs are clearer than others. Oil is one of the can be looked at more as one of the potential wild cards, and we will need to see a break one way or another of this symmetrical triangle before we can get a clear direction. And some of these other assets, the potential price activity is much more clear. So we will see how these projections unfold into the first half of 2013. So for FX Newswires, we thank you for watching this, and if you have any questions, feel free to leave them in the comments below.